James Ewing, welcome back to Truckin On.
Thanks for having me again. Excited to be here.
Yeah, we have our supply chain real estate Q1 update. Well, it's really Q4 2024 numbers. But we're sitting here February 26th of 2025, so we're approaching the end of Q1. And we've been very active in the market, so we can speak to our predictions for what the Q1 numbers might be, but really dig into Q4 DFW numbers. And then if we're feeling the vibe, I say we can go tackle the U.S. as a whole. So we're just going to play that by ear. We can at least touch on some high-level U.S. stuff, like the activity you're seeing out there, running deals and all of that. So,
yeah, sounds good to me.
Yeah, I'm just looking at the blog I wrote for our Q4 recap and really 2024 recap for DFW Industrial, and I titled it DFW Industrial Stumbles Out of 2024.
Yeah, I mean, absorbing about 20 million square feet is still pretty good, but after coming off of 40 million square feet in 2022 and then a little bit more than 20 million square feet last year, it does kind of feel like things slowed down a bit in 2024. There was definitely more opportunity out there for tenants that without a doubt. I mean, we had about 70 million square feet deliver in 2023, and we had another 40 million square feet deliver this year.
Last year.
2024. Yeah.
Yeah.
So just the amount of product that hit the market in the last 24 months, there was just no way that tenant demand was going to keep up with it. So it's shifted from, hey, take it or leave it. You can have the space if you want. It has to be at this rate and these terms, to, well, for the first time in my 5.5 years, we got to beat up on some landlords a little bit.
Yeah, I think that should continue through this year.
I think so too. I mean, I could see it shifting in late Q3, early Q4 to more of a landlord's market than it is right now. There just hasn't been any really new construction started. At the end of Q4, there was about 19.5 million square feet that's under construction still. I mean, that number's just dwindled from the 80 million square feet that we had under construction down to this. So not a whole lot of new starts have happened in 2024.
Yeah, I have 8.6 million square feet currently under construction. Did you see that?
No, I had it at 19 from our Q4 report, but that isn't surprising.
Is that what it is?
So it's probably,
I might have the numbers wrong. That's what I wrote on the market update.
It's I mean, we've got 8 million big box under construction, and then about another 8 million, another 8.5 million that is
that's
non-big
true.
box.
I was thinking big box.
Yeah, I mean, big box, there's only about 8.6 million square feet under construction, which if you look at what delivered last year on the big box side, that was about 30 million square feet. So we're not going to be seeing a whole lot of product hit the market in 2025 from a new construction standpoint.
Vacancy rates at 9.8%.
Yeah.
Overall industrial.
That
is that right? That's overall?
Yeah.
Overall.
Overall, yeah. I mean, that's including like your flex stuff and everything. I mean, if you're just looking at big box, it's at 14%, which I think if you go and say that to almost any other market, they're going to be a little bit nervous. But talking with all these landlords and all these brokers that are in DFW, I mean, the sentiment is that this is going to get absorbed. And it's there's a lot of activity still in the market. I mean, I think after the election after the election was decided at the end of last year, the 2 weeks after that, we started 2 million square feet worth of surveys in DFW. And I don't know if that's because of the election or what happened there, but it just seemed like activity started to pick up late last year, and it's been extremely strong from our standpoint in DFW at the beginning of this year too.
Yeah, I think just like closing out the quarter with 2.2 million square feet of absorption was such a lackluster quarter. And I feel like even though activity picked up, like deals still getting done in Q4 were really slow. I just talked to our friend Dustin Voles over at Newmark, and he said like if he could just like rate like the sentiment of who he's talking to out there, it would be leasing activity was like a 4 on a 1 to 10 scale Q4, and it might be more like a 6 Q1. So it's getting better, but it's not like it's insane out there. I think it's just kind of slowly, steadily picking up steam. And I think this quarter should probably be pretty lackluster, I would guess, in terms of absorption. But then hopefully Q2 we start seeing an influx of deals getting done.
Just having the activity that I've seen in the market, I would expect us to surpass that 2.2 number for sure this quarter. The amount of deals that it feels like we're running into, like there's been a couple of these buildings that we're looking on the larger side. We've run into some competition actually on like a 500,000 square foot plus. There's been a couple groups looking at buildings. So that didn't really happen in 2024. It was really, you were the only game in town if you were looking at a building of that size. So I would rate it more like a 7-8 on my scale.
Yeah, I like that. And I mean, you're out there doing this every day, so you're in the market more than most people. And so, what big deals are out there? Well, what big deals have gotten done?
Yeah, so last quarter there was a 1 million square foot deal done in South Dallas with CJ Logistics, the Asian logistics company. They took about 1 million square feet off of Fulgham Road from Logistics Property Company. That was easily the biggest deal there that got done. Exeter has had a 384,000 square foot space in Alliance that's been available since 2021. That got leased by a 3PL, FST Logistics, last quarter. There was a tire group that purchased a 293 from Stream out in Mesquite. And then there was a 227 done in Denton from Hunt Southwest, and that building's been delivered since 2022. A 3PL took that space. So as far as like the massive 500,000 square foot plus deals, there's really only one that got done in Q4 of 2024. I think that's kind of why that number was at 2.2 million. But interesting enough, Google took down 2 million square feet, 2 1 million square foot buildings last year in DFW. Completed the build out of the one up in Clarion's million square footer in Alliance, and then pulled out of the deal, terminated it. So another 1 million square footer hit the market at the beginning of this year after already being spoken for.
So they signed 2 million square footers and they stayed in one and terminated the other?
Yep.
They terminated it?
They terminated it, yeah.
How did that work?
They had a termination option and a fee that they paid for it. So I guess there was always that chance that it wasn't going to work, but they were so gung-ho about it and put money into it that it was kind of expected that they would take occupancy, but they never did. And
that was data center oriented use for Google?
Yeah, so they have a data center in Oklahoma that they were storing all of the materials to supply that data center with in DFW.
Yeah. Are you seeing an influx of manufacturing deals, or is it mainly like these 3PL distribution deals?
You know, I would say on the deals that we're working on from like a square footage standpoint, it's probably about 30% manufacturing, and a lot of it has to do with solar panel manufacturing and battery storage. We've got a couple of those groups running around, and nothing super, low-level manufacturing. It seems to all be pretty high-tech stuff that's coming in. I expect that manufacturing number to tick up a little bit this year as well, as far as what portion of the market they're taking down.
Have you watched Landman?
No, I've been told to watch Landman I just think I can't get myself to get another streaming service, and I have to draw the line somewhere, and Paramount Plus is that.
My dad just got it, actually, just so he could watch it, and he was complaining to me about it. And then he got it, which he didn't want to get another streaming service. And then he has commercials on it. So now he had to upgrade to get rid of the commercials, which he did, but the commercials are still there.
Oh, really?
Big Rob, he's pissed about the whole thing. But I can feel that. But yeah, Billy Bob Thornton plays this character who's like a oil and gas landman, you know, so it's a lot about the oil and gas business. And he talks about solar panels, and he's, who knows if it's real or not, but he's like spitting off the metrics on how much the carbon footprint is to, I think he's talking about solar panels and EV, but also like the wind turbines that are going on in these oil fields, and just like how kind of ridiculous it is, the amount of money that gets spent. I mean, the carbon footprint to haul these gigantic windmills around on trucks and set them up and do all of that, but manufacture them. It's like it offsets everything that they're saving. It's a pretty pro-oil movie, or TV show. So,
yeah, I do love Billy Bob Thornton, so I might cave.
I love him. Ali Larder is fantastic. She was one of my favorite actresses from my childhood or my college years when she was in Varsity Blues. Have you seen Varsity Blues?
I've seen Varsity Blues, yeah.
She sported the whipped cream bikini.
Yep.
For Johnny Moxon, when he took over as starting quarterback, she just left Lance in the dust and moved on to the new QB1. She wanted to get out of that town.
That might be the only part of that movie that I remember, because I think I was like 12 or 13 whenever I first watched that movie. So
I highly recommend that you revisit that movie.
All right.
It's so good. So, yeah, in general, I mean, I wrote this blog, and it's kind of like, you know, I said stumbles out of 2024. So it's not like we're dead in the water or anything, but it was just an ass kicker of a year in general, doing deals and indecision from, I think, tenants that are out in the market. And a lot of our clients are third-party logistics companies whose business depends on their clients. So it's, at the end of the day, these big shippers and like retailers and technology companies and all these people that have to manufacture and have products for 3PLs to ship and distribute. I think they're just having trouble figuring out what they actually need to be distributing and how much product they need to be manufacturing and where they need to be and what their supply chain strategy is. I think there's been a lot of indecision. So because of that, from my perspective on the deals that we were working on, it's a lot of evaluating multiple scenarios, right?
Without a doubt. Yeah. I mean, it's nobody wants to make the wrong decision. And I think that sometimes leads to an indecision. And I think we saw a lot of that in 2024, where they're just kind of waiting for something to jump out at them and make that decision. But I mean, it's I think that's mostly on the third party logistics side. I mean, the shipper clients, I mean, they kind of have a better idea of their own space and what they need. And I didn't really see a lot of indecision on that side, on those tenants that we rep. It was, they know what they need. We figured it out. And obviously they had to go through all of the approvals that anybody would to make that decision. And it still took a lot of analysis to come up with a plan there. But it felt like we were always on the path moving forward a little bit. And then with some of the 3PL, third party logistics clients, it was very much the tail wagging the dog, it felt like.
Yeah. And I think some of that has to do with the level of sophistication that you're talking about that's going into these facilities. So if you need to have certain equipment and a certain process of doing things, then I think you can be more, you just have to be more proactive. But when it comes to just like storing things in a warehouse and shipping in and out, that has to do with supply and demand a little bit more so. And it's just a little easier to maybe move that product then and you're not doing such labor intensive work, then I think that gives a little bit of leeway for taking your time on what you're going to do.
Yeah. I agree with that.
If that makes sense.
Yeah. One thing that I thought was interesting in DFW was that we actually had negative absorption in the non-big box side of things. So anything 200,000 square feet, we had actually 1.1 million square feet of tenants leave the market there. So
was that in Q4 or in 2024?
2024, we had positive absorption in the non-big box side in Q4, but overall for the year, we had negative absorption in the non-big box side of things.
Yeah, we were just talking yesterday about the Brook Hollow submarket, which is where I cut my teeth when I got in this business, which is the original industrial market of Dallas, and it's a lot of obsolete buildings are there. And when the word like last mile became a buzzword, that market went crazy, especially with investors buying those buildings, but also rents went up, and but people were paying insane numbers for those buildings. Like they used to be $30 a foot 20 years ago, and now they're $150 a foot in some cases. And then finding these warehousing companies to go in there and pay the rents needed because of that, then they have the option to just go to Class A and pay less in many cases than what they're trying to charge in Brook Hollow. But I heard that market's kind of suffered, and people are moving out and there's a flight to quality.
Yeah, and it's just, you can't build anything of quality there really unless you're tearing something down. I mean, there's the only new development that I've seen in that submarket is from Crow. They're building 500,000 square feet over 3 buildings. And we have one group that we're running with in the Brook Hollow area that's in 2 buildings. It's about 150,000 square feet total. And it's they're having that issue of the warehouse isn't really working for them from their operations anymore. So we're looking at that Crow Holdings building just because it's the only nice building in town. So I agree with the sentiment of the flight to quality there.
Yeah, it seems like it's a matter of time before somebody just goes hardcore. Like, I think it's like Rexford Industrial in LA. They just go buy all of this Class B and just demolish it and go build Class A. I'm saying Class B, but really like Class D industrial. We'll get these old, like tear down 2 buildings and build 1 building.
Yeah, I mean, I think
because the coverage ratios there are just like they're not feasible for most like modern supply chain companies to operate out of.
Yeah, I think at a certain point those numbers are going to start to make sense there in the last mile, final mile infill markets.
Yeah, I do feel optimistic that all of the space will get absorbed eventually, but is it this year or next year? That we will see. I don't think we're off to the start of this year that's like we're definitely going to absorb all of our 10% vacancy that's sitting out there in 2025. I think a year ago at this time, I was thinking that we would find equilibrium in the market in mid 2025, and I don't think that's going to be true. I think maybe at the end, but mid 2026, if I was betting on it, might be more realistic.
Yeah, I mean, it's there's a lot of space out there, so I mean, we would have to have a pretty stellar year to find equilibrium. I mean, the lowest that we really got down to in DFW as a vacancy rate was 5.5%, 5% ish. So I mean, from as far as like a large market standpoint, we were still had quite a bit of availability compared to a market like LA or Toronto. Even Chicago really didn't tick up all that much. So I mean, it's our tight here in DFW is a little bit different than tight in other markets, I think. So we still have a long way to go, but I think we're heading in the right direction from an equilibrium standpoint.
When you said that you've been able to beat up on some landlords last year, like how did you do that?
I mean, it was generally there due to the amount of product that was on the ground. Just take South Dallas, for example. There was 23 buildings that you could do a 200,000 square foot deal there.
Just in South Dallas.
Just in South Dallas.
Yeah.
So, I mean, it's pretty easy to get a landlord hungry for a deal whenever you have 23 options. You can narrow it down to your top 5 or 6, go out and tour and RFP those and pit the landlords against each other and get some pretty ridiculous free rent and concessions and even some rent, even some lower rent than you would expect from a year prior. And there's still certainly those opportunities in these submarkets. I mean, I was just talking with a broker that has a listing in DFW Airport for 200,000 square feet, and they did a competitive set that there's 20 options in DFW Airport. I mean, that's now, instead of being the tightest submarket in DFW, I mean, it's at 10% vacant.
Do you think that's because of how expensive it got?
I think that definitely has something to do with it. I mean, the rates haven't dropped drastically there. I mean, there's still, if you signed a lease in 2020 and you're coming up for lease expiration in 2025, do not expect to have a 3% jump. You're going to pretty close to double your rent there still, but instead of growing at a rapid pace of 20% year over year like we had the past 3 years, I mean, it's kind of a flat rent growth there.
Yeah. Yeah, and looking back at the numbers, the rent went down just a little bit from Q3 to Q4, but overall it was still up a few percent since 2023.
Yeah, it's still. We had a 9% rent growth overall in the market this past year, which, if you look at the overall U.S., there were, and you look at the West Coast where. Like in LA, Las Vegas, or Reno, all of their rent went down pretty drastically in 2024. And then you have DFW, Houston, where the rent growth continued. And then you have the outlier like Charlotte, that their rent went up almost 30% year over year. I'd expect that our rent growth would kind of stay in that mid to high single digits year over year. I don't expect it to go completely flat.
Yeah. What about the capital markets? What are you hearing there?
That cap rates are starting to compress a little bit. I mean, we've seen some things trade under that 5% cap rate, which is the first time that I've seen that in about a year and a half. I mean, there were groups out there at the height of the pandemic kind of push there where they were buying things at a 3 cap. It's essentially a government bond.
Yeah.
And then they creeped all the way up to, I mean, we sold a building at it was a 5.7 cap in late last year in South Dallas. So, I mean, it was, it certainly creeped up there. But if you're getting a Class A with a strong credit tenant at DFW Airport, I think you're going to have to be below that 5 cap to win the deal.
Yeah. I've heard the activity is just kind of slow. There's not a lot of buildings trading. And I think it's because people don't want to sell yet. And these interest rates are still high. I think it's moving in the right direction to go back down again. And I think there's good liquidity, but I just think people don't want to sell.
Yeah. I think it's tough for these groups that saw those 3 caps being traded, built their buildings, and now their building's a 5 cap, and seeing the value that they could have gotten back in 2022 to what it is worth now. I think they're trying to hold on a little bit for that price to start creeping back, or that cap rate to start creeping back down. I don't think it'll get back down to a 3 cap at any time in the near future. There's plenty of, every time I talk to somebody, I just hear about how much dry powder everybody has on the sideline waiting for the right opportunity. So I think it's bound to start coming loose here, and some things are going to start trading. And
I think that's also a function of the tenant demand. So until it's really proven, like, tenant demand is back and it's steady and strong. I mean, Trump just made so many changes to I think the Constitution. I don't know if it's a Constitution but there's so many different laws that are coming out that, I mean, I don't keep up with it. I can't. But there's so much change going on. It'll be interesting just to see how that impacts. And I would think in general, Trump is a good businessman and that should be good for business. But there's just lots of changes going on. There's lots of geopolitical turmoil that's occurring as a result of those changes. And that, as we know, can just make things swing one way or the other that nobody knows which way it's going to swing, though. So, I think a lot of this, while there's money on the sidelines ready to go, it's there, but it's not really ready because they want to see what is going to actually happen. As do I, frankly.
Yeah. I mean, the tariff threats and what's going on there. I mean, I don't know which way it's going to swing. It sounds like that a couple of deals that with our partners up in Toronto, they had some things that were on the finish line that with these threats that came in, the deals kind of died on the vine there. So, I mean, it'll be interesting to see if those actually go through and how that affects the Canadian market up there. I mean, I just think that from the Mexico-U.S. Texas border there that I don't really see demand slowing down too much. Having the amount of work that we do in Mexico, it still feels like it's extremely strong there, even with the looming threats of putting tariffs on Mexico.
Yeah, I think the Mexico sentiment is still very strong, and it's been much easier for us. Like last year was kind of a grind in the U.S. It's still way easier in Mexico, just to like get approvals for deals, because I don't think the Mexico market's going anywhere. They have such low vacancy rate there, and they have such great labor and the proximity to the U.S. I think they'll figure out this. I think a lot of what Trump does is posturing anyway, and we'll get to a good place where I'm hopeful that trade will be enhanced between the U.S. and Mexico, and it'll keep driving activity in both places. But I don't think any of my colleagues and our colleagues in Mexico are worried, and I'm not worried about Mexico taking a hit and like having vacancy rates rise there.
Yeah.
I think it'll be the opposite. It'll keep tightening and going up in cost. So let's see. Now we've gone international. So I feel like we should just go ahead and knock this baby out and get into the U.S. industrial market. And I mean, the biggest story is this gap in supply and demand. And in 2023, it was like 2.6. Supply was 2.6 of that of demand. And then it's 2.4 in 2024. Sorry, that's demand is 2.6 multiple of like where the supply is. So
yeah, we have 2.6 times the supply than we have the demand.
Thank you. I can't speak. And then 2.4 is happening this year. So it's just like the levels of supply have gone down, but the levels of demand have also gone down.
Yeah, I mean, it was. I think our head of research kind of showed what percent of supply demand is in each region of the country, and I mean, if you look at to the Midwest there, I mean, it's pretty strong at about 70% of supply.
77%.
77%. Yeah, there's 77% of the supply. There's a tenant need for it. And then you come down to the South, it's what, about 60% of what it?
50.
Yeah.
It's 50 in the Northeast, it's 50 in the South, and then the West is 7%.
Yeah.
So the West has just been getting hammered. Tenant demand is very low. The majority of the activity there is from these Chinese 3PLs, from what I've heard. And they're getting in there and signing leases. Their credit is not as good for these institutional buyers as the credit of, the U.S. companies. But it's still just like the activity out West is way off, and the rents have drastically dropped out there. Vacancy rate has drastically risen.
Yeah, I mean, we were running a project. It was 250,000 square feet, and we needed to be near Ontario, California there. It's kind of heart of the Inland Empire. And I think we had about 25 options within a 10-mile radius of us, which sounds like South Dallas to me. So it's pretty crazy, the drop off. Because I mean, I remember working on some projects with Cole and you out in LA in 2021, and it was just like like almost $30 per square foot triple net rents, and then now those are in like the high teens. Yeah. So it's just still some crazy rental numbers just compared to DFW, but I mean the drop off is pretty drastic there.
Yeah, I feel like Canada's kind of dropped off a little bit like that as well. And it's like Toronto was very similar story to LA, but it's not taken as big of a hit, but it's still taken a hit there from what it was. Yeah, the tenant demand has slowed there.
Yeah, they're worried about like a 3.5% vacancy rate or a 4%, whatever it is. It's really low in comparison to a DFW or even an LA right now. So it's their slowdown is a little bit different than I think everybody else's, and it's just because they can't build as quickly as we can down here.
Yeah. There are some U.S. markets that have found equilibrium. Chicago is probably the biggest one. Savannah is doing pretty good. Salt Lake City are a couple of the major markets that are doing okay. But then other markets that are struggling pretty bad is the Bay Area, Reno, Sparks, Memphis, where we just were. Portland, Oregon's taken a hit, Sacramento and Charleston.
Yeah, I mean, we've just Memphis, for example. I don't think there's been maybe one building that's been completed in the last 18 months there. I mean, we're working on a project there right now where it's like a 300,000 square foot building that we're looking at for 1 year, and we have 12 options for a 12-month term. I mean, you would have told me that 2 years ago. It would have been nuts. So I think in most of the U.S., these landlords are still very hungry for a deal. And even in a market like Charlotte, where the year-over-year rental increase has been close to 30%, we're completing a deal there now of about 160,000 square feet. And we had 7 or 8 options there, and we're able to get 6 months of free rent on a 5-year deal. It's just so, even whenever a market rent growth is growing like crazy there, I think there's still opportunity in every single market right now.
Yeah, and you're in the market for that deal, and I've got landlords calling me, who all the landlords that had vacancies in that market calling and aggressively chasing that deal. Yeah. You know. And that tells you something. But construction's returned. It's our report, which I'll put a link to, or you can just go to supplychainrealestate.com if you're listening, and you can find our DFW market report and also the U.S. Q4 2024 report. And it's on the slide, it says construction has returned to pre-pandemic levels, but it hasn't returned. It's below pre-pandemic levels. So everything has gone drastically down after the drastic post-COVID boom. Development activity is down 60% from its peak, is the stat. And the peak was Q4 2022. So just to think that in 2 years, it's off by 60%. That's nuts.
Yeah, and I don't think there's going to be once things find an equilibrium, I don't think we're going to see the dramatic increase of construction either. I think these landlords are going to be a lot more conservative with starting new projects. I mean, it was like you couldn't do anything wrong there for 2 years. You could throw up any project, it was going to get leased no matter what. And now I think they're starting to be a little bit more strategic.
Yeah, but we always say this is going to be the case. When the Great Recession happened, it's like they'll never let overbuilding happen again. And they'll never let any of this happen again. But then something like COVID happens that we've never seen before, and it's crazy. And the demand requires the supply, but then you just don't. It's impossible to time it perfectly. But I do think if you're in the industrial real estate business, you're pretty safe, compared to an office developer in 2019 that's building buildings then thinking, oh, this is never ending, this office sector. And then all of a sudden everybody is forced to not go to the office. Nobody saw that coming. And frankly, frankly, with like just the insanity of the world today, like who knows what unforeseen event could occur, which dramatically impacts supply and demand in ways that we can't even imagine.
Yeah, I hope it's the good side of demand, but yeah, it's always a little nerve-wracking for sure. But like you said, I would rather be in industrial real estate as an asset class than any other right now. It just feels like it's the most insulated. People need to get things to their home, and it's all coming through a warehouse. So from that perspective, I don't really see it shifting away.
Yeah, I agree. Office space, I don't understand why people would go office in like a suburban office park anymore or do something like that. I get the new Class A buildings. Multifamily, it seems like I think a lot of people are struggling out there right now from being on Facebook. I have lots of friends from all different walks of life, but there's a lot of trouble in the economy right now, and people are struggling, so they're not going to want to go pay higher rents. Office, sure, big tech companies that are making billions of dollars, they're going to go lease really nice office space that are in, bustling areas like Uptown or Frisco or something where they have access to all these amenities, but all the rest is in trouble, I think. Mm-hmm. Vacancy rate in the U.S. industrial market has increased for 10 quarters consecutively. So it keeps ticking up, but it has slowed. Like I said, I think it's still going to keep ticking up through this year, probably, maybe through the first half of the year.
And I think it's kind of it's almost like a tale of two markets there, where if you're in the market for almost any major market and you're looking for a big box space, that vacancy rate is probably going to be higher than if you're looking for 100,000 square feet and under. So it's going to be a little easier to get the concessions and the lower rental rate that you need if you're looking for a 250,000 to a million square foot building in a lot of these markets, versus if you're looking for 50,000 square feet, that market is still tight in some of these larger markets. We did a 30,000 square foot renewal in north of Seattle there in the end of last year, and their vacancy rate was at a 5-year high at 3%. We didn't have any good options to move to, so you're kind of still stuck where you're at in smaller spaces, while the larger spaces, these landlords, like you said, they're calling you about a deal that we're working on in these markets to try and get in front of our tenants. So I think there's a lot of opportunity still out there for the big box size.
Yeah, I'll kind of run through some of that vacancy, some rates on different markets. Inland Empire is 6.3% vacant. That's up 118 basis points year over year. Phoenix is 12.4%. That's 483 bips higher. And that's insane. Chicago's pretty good, and it's at 4.7%. That's like very healthy. Chicago did great through this whole market, and just they didn't overbuild, and the demand stayed steady. So they were really good. DFW, we've already discussed, at 9.8%. That's 140 bips year over year. Houston is pretty solid at 6.7%, and it actually went down.
Yeah, Houston had a great year. They I think they led the country in absorption.
John Nicholson had a great year, I see. He was the top producer at Colliers Houston. He just crushed it. So what's up, John Nicholson? I need to get him on the podcast.
Yeah, you do.
He did some big deals, clearly. He got NAIOP Broker of the Year, too. But taking advantage of that active Houston market. Atlanta went up to 8.6. Philadelphia went up 7%. If you look regionally, it's 7% in the West, 5.3% in the Midwest, 8% in the South, and then the Northeast is 6.8%, which is still pretty high for the Northeast. That's a 120 bip jump, and then like the West, it's a 220 bip jump. So, and the vacancy rate's highest in the markets that have grown the fastest. Duh.
Yeah.
Like the people that overbuilt are in trouble. But it will all come back around eventually. And let's see, rent growth, it's slowed to 5% in 2024. So if you look at this chart on at supplychainrealestate.com, the U.S. Industrial Market Q4 2024 report, you'll see the rent rates, and they were very steady, and then they jumped very high during COVID and post-COVID, and now they're going, they're just flattening and going down a little bit in some places, a lot if you're in LA. Let's see. Rent growth varies in markets throughout the U.S., like we said. Yeah, you said 9% in DFW. The big negatives are out west. Las Vegas is down 20%. Greater Los Angeles is down 16%. And Charlotte's actually up 30%.
Yeah.
So that's interesting. But those are a few tidbits there. And I think that's it. So what do you think? Do you think the economy is just going to pick up and be steady and growing, or do you think that we'll see some kind of big correction?
I hope it's steady. I don't have a crystal ball. I don't think. I'm just curious how inflation's going to react to some of the things that Trump's doing. There's, like always, there's people on both sides that think it's going to go extreme one way or the other, and I think it's probably going to be somewhere in the middle. So I think it's. So far it's been pretty steady. Even whenever we expected a recession the past couple of years, it's held pretty steady on the jobs report. And the labor market's still extremely tight. So I'm hopeful that it's just going to be a steady climb back to equilibrium in the industrial side of things.
I think like the growth in market cap on all of these like AI companies and tech companies is concerning to me, how fast like the NVIDIA stock has grown. And I just don't understand it. And it seems crazy how it reminds me of like when the internet was invented and there was the big tech bubble then and it busted. I could see there being like a similar AI type bubble that bust, and that a lot of people that are in the stock market will lose their asses because of it, because it's overinflated values of something that like, you've seen it. Like the Chinese company says that they can do AI without having to build data centers, and that it's not as complex as it's being made to sound. So I don't know about that world, but it's always concerned me, these tech companies that have a good idea and they go execute it, and then they hire like 1 million people and take down like tons of office space all over the world. And that never seems to make sense to me, how that growth is so rapid, and it seems like it's not real.
Yeah.
And that's of concern to me, because of course, like at the end of the day, if all of this stuff is not real, and then there's all this inflated value that's out there that's not real value, and that gets exposed and it goes away, then a lot of people are going to be struggling financially, and then they won't buy things, and then we won't need as much products and not as much warehouse space and all of that. And we'll be the first to tell you if that's happening, because I think that industrial real estate market's a great indicator of what's happening. That's why I love what we do. And right now, I think that it's telling us to be conservative and make decisions, make conservative decisions right now, and don't do anything crazy. Don't go make crazy decisions. Don't go build tons of speculative warehouse space. Like, let's just see how this market responds to where we're at right now, and keep your head down, stick to the fundamentals, and everything's going to be okay.
I would agree with that.
Right on, brother. Well, that's all I got. Do you have anything else to add?
No, I think I'm all good on my end. Appreciate you having me back on.
You got it. Thanks for trucking on, James Ewing, a.k.a. Jimmy the Kid, a.k.a. Young James. And with that, we're out of here. Peace.